Welcome back to the Unique Hospitality Podcast. I am your host, Connor Schwab. Today I won't have our fearless leader, Nick Perslow, on. This will be another solo episode with just me. So we'll have to try to do our best to get on without his quick wit and wonderful British accent. But I do think we've got a pretty juicy episode ready for you today that's packed with insights. And today we're going to be diving into what is your glamping business worth? Or what could it be worth if you were to sell to a buyer in the market? And it's really a big and loaded question, and it has a lot of components. And as I'm sure many people who are building a business are thinking about this. So I wanted to dive in with two leading experts on this question and two differing perspectives to essentially dive into, what are the strategies and tactics that you can either be thinking about when you're looking for a property, or if you're currently operating and you want to really try to position your business to sell for a maximum sales price. So today I'll be joined by Bob Kaplan, the founder and leader of NAI Outdoor Hospitality. So they are a brokerage team that's 100% focused on outdoor hospitality, so RV parks, campgrounds, and glamping resorts. They've been specifically in business in that niche for 8 years. And then we'll be having Shari Heilala, the founder of Sage Outdoor Advisory, my good friend and boss in some respects, and her experience basically doing appraisals and feasibility studies for 15 years, with about 6 of those being in, focused on outdoor hospitality and glamping, and some of her RV experience going well before that. And what's really great about today's guests is that Shari and Sage Outdoor Advisory, they do appraisals. Appraisals is basically a theoretical way to come up with the value of a business or property. There are three ways in which to do this, but at the end of the day, it's theoretical. And appraisals are extremely important in any sale, particularly surrounding financing. So it is a very important tool, and that's used in all or most transactions. But appraisal still doesn't tell you the market value of a property. The only way you can find out the market value of a property is by actually selling it in the market. You never know. The price of something is only worth what someone's willing to pay for it. And so that's where Bob and his team and expertise can bring a lot of color to say, Shari can basically bring the perspective of here's how we value something as an appraisal and through the 3 approaches in the project we've worked on. And then Bob can come in and say, here is how the market is valuing it. Here's how buyers are valuing it. Here's how sellers are. These are the things that they're looking at. These are the transactions that we've seen. So it's a really nice kind of 2-prong approach to this perspective. I'm excited to dive in because it's a big and important question. It has a lot of nuance. It's particularly tricky in our market. If you're talking about glamping, there's really only been maybe a dozen transactions or even well less. The market's really in its infancy. So there's really not a lot of data for anyone to point to in coming up with this. So it's very tricky. So that's where Bob and Shari's experience is going to really come in handy. So I'm excited to dive in with them further today. Hello, friends. This episode is made possible by the support of Live Oak Bank, the industry leaders for outdoor hospitality financing and the largest SBA lender in the country. If you want to learn more about their services and if it's right for your project, you can go to their website, liveoak.bank. Thanks. Now back to the show. All right. Well, Bob and Shari, welcome to the show. Really appreciate you guys hopping on.
Thanks. Hi, Connor.
Thank you. It's great to be here, Connor.
Yeah. So today we're going to talk about, glamping business valuations and appraisals and buying and selling, your property and your business. Before we jump into that, would love to just hear a little bit more about the businesses that you both lead now, and the type of services you offer and kind of experience you have in the industry. And then we can talk about how you got into outdoor hospitality. But yeah, maybe Bob, we can start with you.
Okay, happy to start. My name is Bob Kaplan. I'm the founder and managing broker of NAI Outdoor Hospitality Brokers. As the name may indicate, we are a commercial real estate brokerage firm, a boutique firm specializing in the acquisition and disposition of RV parks, campgrounds, and glamping retreats. So what do? We help buyers and sellers buy these unique and wonderful properties throughout the country. The company was started about 8 years ago. I'm a, I'll let the rest for later on, but I've been in brokerage for over 24 years, and I found a need to jump into this space, which we'll talk about later on. But yes, we primarily offer marketing and seller representation of RV parks, campgrounds, and glamping retreats.
And how long have you had the name Outdoor Hospitality?
About 7.5, 8 years.
Wow. So I think that's the best umbrella description for what we do, and it's kind of like just catching on. And I feel like you might be the person who's been using that the longest that I'm aware of. So well done.
Well, thank you.
Unless Shari, I don't know. Did you ever call? I know you were more in outdoor resorts and kind of that side of things.
No, we just changed our name to Sage Outdoor Advisory. I think when you joined the team, 3.5 years ago, something like that. So Bob's the pioneer.
Shari, you want to chat about a little bit about Sage and what we do?
Sure. I think anyone who listens to the podcast might know a little bit about it, but I am the founder and president of Sage Outdoor Advisory. The company itself was established 12, 13 or more years ago. And I've been in the commercial real estate business for almost 35 years, and about 27 of them in appraisal and consulting. And breaking it down further, I'd say I appraised my first campground and RV resort in 2005. So that's headed towards 2 decades of working in this industry, and was really fortunate to work on a pretty big proposed glamping project back in 2018. And that's really when the company started focusing on becoming experts and developing data in that space. And we work not just nationally, but pretty much in all of the Americas, and have been doing a lot more out of country projects lately. But we do feasibility studies and appraisals on glamping resorts, unique stay properties, boutique hotels, and RV resorts and campgrounds.
Amazing. So I think probably you two have seen or dealt with more outdoor hospitality transactions or appraisals or valuations than perhaps anyone I know in the space. As far as across different brands, I'm sure someone from Getaway's done a lot of transactions. But as far as you guys being agnostic and seeing all the different outdoor hospitality transactions, there's probably very few people that have seen as much as you two. And in the glamping space, that's probably still not that many. It's very, very small. I mean, the glamping industry has really only been around for maybe 10 years and is far, still in its infancy. So, 80% probably of the glamping properties in the US aren't even yet stabilized in year 3 or 4 of operating. So even fewer have transacted or changed hands. So it's a really difficult space to have a lot of sales information in, but we'll use what little information we have from you two, which is probably some of the best sources of information on this topic. And so I'm very grateful to have both of you in. And as I mentioned in the intro, today's podcast is really about understanding how appraisers and how brokers and how buyers might value your business or your property for a purchase. And ultimately, if a sale of your glamping property or business is in your future, what are strategies that you can start to think about and work towards now so that you can maximize your sale price in the event that that happens? And I also think it's really nice that we have two different perspectives, and that is appraisers play an extremely important role in banking and understanding the valuation of properties, but they are essentially theoretical, and it's a theoretical valuation of what something will be if it might sell. Whereas Bob works on the side where he is actually getting, he is actually coming up with the price that a buyer and a seller agree upon. So it's the actual. So, or did you want to comment on that, Bob?
Well, let's be clear. A broker is a market maker, and we accentuate the positive. We learn as much as we can about the property. We market the property. We disseminate information. But if a broker does his job well, he creates a market, and the market determines the value.
Mm-hmm. Yeah.
We're a facilitator, we're a communicator, et cetera. But if we do our job well and multiple qualified buyers look at the property, then it's actually the market that determines the price. What we have to do as brokers is stay in touch with and tune to the market so that we can predicate or we can give an indication to our client where we see the market now and where their property should trade.
Perfect. That's great clarification. And we'll get into that a little bit more in a second. And I guess would love to just get a little bit of a personal background on both of you. Bob, can you tell us, how did you end up getting into the outdoor hospitality space?
Sure, happy to do it. Usually ladies go first, but in this one, it seems like I'm going first. So, Connor, I've been a commercial real estate broker for 24 years. I have always sold income producing properties. In my first 15 years, I sold apartment buildings. I've sold some industrial, I've sold retail, et cetera, but always an income stream. About 9 years ago, I went into management for one of the commercial real estate brokerage firms, one of the nationals. That was a wrong turn, didn't like it. And as I was in that position, I saw what was going on in this space. I saw the consolidation of the space, I saw the growth in the space. And I also felt that there was a need for more qualified and higher caliber brokerage to service the industry. And so 8 years ago, I jumped in and started this company a couple years thereafter. So I saw what was going on. I guess similar to Shari, you kind of saw what was going on there and felt there was an opportunity. I liked what I saw in the industry. I thought there were a lot of fun people. It was a lot more fun than selling apartment buildings, et cetera, and going to neat places such as Moab and Durango and the Wisconsin Dells or wherever. And so we jumped in. That's how I got involved.
Awesome. Thank you. And maybe you could tell us a little bit more about like what a day in the life of Bob and his team at NAI is like. What are you helping clients with? And then maybe you could tell us a little bit more about the volume of properties and the type, like how many RV, how many are campground, how many are glamping, and like what you're doing for those clients.
Well, you certainly hit the head on the nail about there not being many glamping trades yet because it's a younger industry. There's not as many, and not many of them are not even stabilized yet. So we are just starting to see more glamping retreats come to market. And it is a bit more difficult because they are so special. One group wants to create community and have all the units next to each other. The next group wants them all to be spread out and for people to have privacy, et cetera. So they're very different. So they're a bit harder to market, and it's a bit more specific because they're so unique. But we're seeing more and more of that. But really, so far today, glamping is maybe 10% of our business, but I anticipate within a few years it will be perhaps 30, 40% of our business. It's hard to tell, but definitely growing. A day in the life, a lot of communicating, a lot of proposals, a lot of talking to people, a lot of speaking with owners, seeing how their property is doing, speaking sometimes with appraisers and lenders to know where the lending environment is, et cetera. It's one of those things where every day is different. Some days you have your head in spreadsheets and income statements trying to help determine the value of a property. Other days you're talking to people all day long about a property that you're marketing or whatnot. So it changes a lot, but a lot of communication.
Awesome. Thank you, Bob. How about you, Shay? How'd you get into the space?
How did I get into this space? I touched on it a little bit, just, being a generalist as an appraiser and consultant in commercial real estate. Uh, got to do a campground appraisal in the mid 2000s. And I've always liked hotels. I've always liked something that's more complex. Appraisal itself can be kind of a dry, a dry profession.
But you make it
So
fun.
yeah, I do my best. So I wanted to do the properties that were the most fun. And the other office that I was at before I started my firm, I just always raised my hand for that kind of thing. And it's, not just it being an interesting and dynamic industry, it melds things I like to do for fun in life with my profession. And I think later in your career, that's a wonderful thing to be able to do. Um, so that's just, yeah, that's kind of the long and short of it.
And what is a day in the life like at Sage? What type of clients are we working with? What do we do for them?
Yeah, let's see. Bob said it so succinctly. I feel like I could go on forever, but I think it starts with talking to people that are looking to develop their resorts. For the most part, I do have a number of clients that are looking to buy that we also consult with and help with some of the due diligence or sell. And but the majority of our clients are looking to develop from the ground up or to add or enhance what's there. And as you know, Connor, a lot of it, once we've kind of partnered with our clients, it's really understanding what they know, what they don't know, what they really want to learn the most from us. A lot of times it is connecting them with financing. It's a lot of research in the market, understanding their target market, determining the best unit types and amenities, and really looking at the financial metrics to figure out what the best plan is and if it's viable truly. But it's a lot of fun. We get to look at a lot of fun properties in our research. We get to go to some pretty cool places. I just came back from the Bahamas on a small boutique hotel oceanfront project. So, but a lot of it is sitting at your computer long hours and making sure that we do a good job for our client. And I guess the final thing is really talking to people like Bob and other people in the industry that manage resorts and um, to make sure that the assumptions and knowledge that we're applying is real in the industry. A lot of people will complain about, in the appraiser role, at least, that, that it's purely theoretical and really not based in reality. And I've worked very hard to talk to people and make sure that what we're doing really makes sense in the real world.
Yeah, and I can say, from having worked at Sage is one initiative that Shari's always been really big on, and I think Bob, it's something that you're big on too, and that is constantly checking in with service providers, leaders, owners, and operators in the market to see what's happening and what's changing, because you have to keep your finger on the pulse. Because really, the market, especially in the last 4 years since COVID, I mean, it really seems to totally change every 6 months. There's like a new crazy thing happening, whether it's COVID and all hotels are open, or international travel's opening back up, or there's huge inflation or interest rates shoot up, and how that is impacting occupancy and how that's impacting development costs and interest rates and valuations. So it's constantly changing. I know you both do a great job of keeping in touch with leaders and operators to keep a finger on the pulse of those changes and how it's affecting the market. And Shari, we'd probably agree with what Bob said in terms of, I guess, to put it in perspective for the listeners, there's 13 to 15,000 RV parks and campgrounds in the U.S., and there's maybe 1,000 or less, professionalized glamping locations. So it's less than 10%. And whereas maybe 80% or more, maybe 90% of those RV parks and campgrounds have been around forever and are fully stabilized with their occupancy. But on the other side, 80% of the glamping sites are not yet. They haven't reached year 3. Their occupancy isn't stabilized, so it's very, very different. So I guess maybe, Shari, we could dive into the appraisal world first. And I guess to give the listeners some context, to be an appraiser, you have to get your appraisal certifications or your license. And then the next step above that is an MAI, which Shari has, which is the highest level of certification. So maybe, Shari, you could tell us a little bit about that and like the appraisal world. And then you could dive into, in the appraisal world, how are you coming up with appraisal valuations for glamping properties, businesses, and how that works?
Yeah, absolutely. Um, it's the education requirement and experience requirement to be a certified general appraiser, which means you can handle commercial properties and not residential, is pretty extensive. And I'll be honest, I got those accreditations a long time ago, so I don't know what the hours are, but it's something like 3,000 for an MAI. It's 3,000 hours of experience. We go through many classes. We either have to write the mother of all appraisal reports to prove we know how to do everything, or there's some alternative ones. I went in front of like Spanish Inquisition style with all these leaders in the appraisal industry, just drilled me. I just felt like that was easier to get it done. But yeah, you've got to submit work. You've got to do a lot of education. And then for an MAI, you have to pass a 2-day, very comprehensive test as well. So it's a pretty long road. And having been in the business a long time, for everything that we need to be able to do to analyze data, write well, communicate well, and problem solve, it does require the best of the best, and it's tough work to be honest. But so that's kind of the qualifications. Actually, it does require a college degree as well. But you wanted me to then go into how we approach valuation, right?
Mm-hmm.
Okay. Yeah. So much fun. So there's 3 approaches to value in the appraisal world, and it's the cost approach, and the income approach, and the sales approach. The income approach is what really drives value for glamping and resort properties. But I'll talk about the others really fast. The cost approach is basically the value of your land plus what it costs to build. And if it's existing, you take out depreciation. That's just a gut check. If for some reason your value day one that you open is like 3 times what you're coming up with the cost to build it and buy land, something may be off unless it's just impossible to get entitlements kind of thing. So the sales approach is where you find comparable sales and adjust for differences to come up with your value. That works really well with houses and a subdivision and simple industrial buildings and stuff like that. But we have maybe a dozen sales across the country of true glamping resorts. That's probably even more that's really there, but at least 6. And they're so different. They're in completely different markets. And really the only data point that's super meaningful there is the cap rate that they sold. And that gets complicated too. But a cap rate is kind of the driving factor in the third approach, which is the income approach. And that means that your value is really based on the projected income that the property can make. And then there's metrics to convert that income into value. I could go on in high depth, but maybe we wait to see how far you want me to go.
I think that's good, and we could spend an entire podcast talking about those 3 approaches and the nuances. But in terms of listener attention, maybe we'll shift over to Bob, and you can kind of, and then that's. As I was mentioning, it's kind of like the theoretical world, which is super important in banking and for clients, but then it moves into the market. And as you mentioned, Bob, you're essentially a facilitator of market. And could you dive into a little bit about how those 3 appraisal valuation approaches filter into your world and lead to an eventual sale, how it's the same and how it's different?
Sure. Replacement cost doesn't really do much in our world. In fact, many properties are trading below replacement cost at this point. But what we really spend almost all of our time on is cap rate. and to some degree comps, because that's how we determine what the cap rate is by looking at what cap rates other properties trade at. But we really dig into a cap rate, which is it's the return on investment that a buyer is willing to accept. It's an unleveraged return on investment that a buyer is willing to accept based upon current income. And so, as an example, a 10 cap implies that a buyer is willing to pay 10 times the current income because he is willing to accept a 10% return. So it's a multiple on earnings. It's kind of inverse. The lower the cap rate, the higher the price. The higher the cap rate, the lower the price, and that's what kind of confuses people often. But we really look at cap rate a lot. But we also look at, to create that cap rate, we look at the size of the asset, the quality of the asset, the quality of the location, the barriers to entry in that location, the amount of competition, occupancy rates, expansion opportunities, et cetera. The real estate is still location, location, location. You've got to be near a strong demand driver, be it an industrial demand driver, with work, or be it Niagara Falls or a major driver. But we focus a lot on cap rate, and the cap rate also varies by how much of the income, and this is particularly important in the glamping world, is how much of your income is pure lodging income versus food and beverage income or gift shop income, which has a higher cap rate applied because it requires so much more man hours, it's so much more difficult. So on a larger property, we'll bifurcate the income streams and assign a different cap rate or multiple on earnings on each of those to come out to a blended cap rate. Particularly if a property has 15, 20% food and beverage and other income. I mean, I just looked at a property the other day that 9 or 10% of their income is golf cart rentals. I don't think you're applying an 8 cap on that, but it's good business. So we primarily look at the income and the expected income. Is the income growing? Is it stagnant? Is there excess land and enough water, sewer, and land to build more spaces? Is there enough occupancy? So those things can drive cap rate down or up.
Connor, should we talk about outdoor hospitality financing?
We definitely should. It's one of the most important things to talk about.
And also one of the hardest, right?
Yeah, it is commonly the biggest hurdle for people launching projects in our space.
One of the best ways to get financing for outdoor hospitality projects is through the SBA loan process, or the Small Business Administration loan process. So, Connor, do you want to tell us a little bit more about that?
Yeah, the Small Business Administration is a government body that essentially backs private loans aimed at proliferating small business growth throughout the U.S.
It's funny you mentioned that, because today's episode is sponsored by Live Oak Bank, who, along with standard commercial loans, actually specialize in small business administration loans for outdoor hospitality. We've had Nick Parker from Live Oak Bank on the podcast before, so you might remember the name. And we couldn't speak highly enough about them as a company. And Connor, I know you've actually worked pretty closely with them on a few projects of your own with Sage.
Yeah, they're one of our biggest partners at Sage. We probably do a quarter of our projects with Live Oak, and they're excellent. There's no lender I'd rather work with. They understand the space very well. When you're approaching conventional banks, they're often not going to understand the nuance and valuations and business operations of glamping because it's so new. But Live Oak does understand it because they've seen so many of these, and they're also they are the largest SBA lender in the country. So they know how to use the loan product type that is most appropriate for someone launching a glamping business.
Yeah, I can vouch for that. They absolutely get this space and they get the operators within it, and they truly are passionate about getting these projects off the ground. So both of us couldn't recommend them highly enough. There's a reason we've partnered with them. So if you do want to get your outdoor hospitality project financed, then we're going to send you to Pierce at Live Oak, and his email is pierce.verchik@liveoak.bank. If you want to know how to spell that, then the email will be in the description of this episode. So go and check that out along with the link to the Live Oak website. So if you want to get outdoor hospitality financing, go and speak to Live Oak and tell them that we sent you. Cheers.
Let me ask you both a super annoying question that I know you both have been asked 100 times, and I've been asked it. But it's such a it depends answer. But that is, I'm sure people are thinking it. What are typical cap rates, in the glamping industry, and what are maybe like the top 3 to 5 factors that you're looking at that might, if there's a starting point for a cap rate that you might start at, and then what's bringing that up or down, and what might be like the top or bottom that you tend to see. I don't know if either of you is willing to take that first.
I can first, and then Bob can correct it. I think for glamping, the range is probably 8 to 12% for a cap rate, and then I'll stop there, and then we can talk about factors. I'll see what Bob says.
I would say, yeah, I agree with you. And the sort of the bullseye there is 9 to 10. Yeah.
Nice.
And the discerning factors are what I mentioned earlier, percentage of core lodging income, which is the best type of income, is the lowest cap, versus food and beverage income and other income such as, like I said, golf carts, etc. But yeah, it's in the 9 to 10 range. Location, age, expansion opportunities, etc. play a factor in that. And glamping retreats generally are going to have a higher cap rate than RV parks because there's more FF&E. And there's more labor. You're doing more turns. You have beds. You have furniture. You have other things that depreciate more than an RV spot. And so for those reasons, they trade at higher cap rates, more similar to hotels.
So I can jump in on, let's see if these are really the top 5, but the things that come to mind to me is the property stabilized? You will do a discounted cash flow and a multi-year projection if it's not, but if you're talking cap rate, maybe it's able to stabilize at 65%, but it's in year 3 and it's at 55%, and you're doing some quick math. Bob mentioned expansion capabilities. Absolutely. In fact, I have seen a number of appraisals out there in the world that don't consider that. And actually, those are really good buy opportunities if the appraisal set the price. But Bob will know it if he's listing it for sure. And is that expansion land entitled? That is one of the best things you can do in a higher barrier to entry environment. Get the entitlements in place, even if you don't intend to do it yourself. You may sell it that way someday. The elements like food and beverage speak to the risk of the income. So I agree with that. What are the risk levels to each piece of the income and what can affect those? But on the flip side of good risk or bad risk, I guess, in the neighborhood, do you have things going on that are propelling tourism and reasons for people to come? Is the local ski hill expanding, or are there some other activities out there? A marina just started offering boat rentals that your customers can go to. If you see the opportunity for the area to grow and elevate the glamping operations, that lowers the risk, or vice versa. If other things are happening like flooding and fires, that can increase the risk. The structures that you have, I think, could impact your cap rates. Are you canvas structures? Are you hard walled and stick built? And what is the risk and the need for replacement with those structures? And then obviously location. If you're just in a prime location, if Bob lives near Aspen, if you could get entitlements right near that ski hill, maybe we're below that 8% cap rate then. But I think that's probably impossible. But those are my top ones I can think of.
Well, I completely agree with you, particularly on entitlement expansion, demand drivers, and proximity to population. Demand drivers always important, but also, it needs to have a proximity to a population. It's few and far between the glamping resorts that are really far, 5-6 hours drive from a major airport that do well. And the ones that are very far away from things tend to be very, very high end. So location is important. The demand driver is important. And regarding entitled expansion is great. And it's important that your expansion opportunity is entitled. Non-entitled expansion opportunities are not worth a lot because of the time, energy, and effort it takes to get the entitlements. So I encourage owners, if they have, they perfect those entitlements. But you also need to make sure you've got the occupancy to support that. And I think that was getting lost a lot during the COVID boom. Well, I've got expansion opportunity. Yeah, but you've got, can you, support that additional X number of sites without just, hitting just a few weekends? Do you have enough occupancy during the season, a high enough occupancy during the season to merit an expansion?
This is such good advice. And just to hit that point home, basically, yeah, if you have additional land that hasn't been developed on your property, if it is permitted and entitled, it's going to be worth a lot more in a sale, because that usually takes several months or several years to get it done. And as Bob is saying, but that only makes sense if the demand has been validated in that market and a buyer is going to be confident that that expansion will actually produce income. And you guys mentioned something about, going into a market with high barriers to entry. I mean, this is one of the most common conversations we have, and it's the biggest hurdle to getting into this space is, zoning and permitting. And I always joke with people, the best part about developing in Texas is that there's no zoning. And the worst part about developing in Texas is that there's no zoning. And so it really is a double-edged sword. And, oftentimes people will go to the path of least resistance, which certainly has some merits, but you're not going to have as good of a competitive moat that's going to slow down other competitors from coming into that market. And we see that in Texas. We saw that in Zion, Austin. We saw that in a lot of locations. So, when I'm hearing about or looking at a property and someone tells me it took them 3 or 4 years to get their permitting, I'm like, oh, hell yeah, that's probably a good market to be in. Because that means anyone else who wants to go in is going to have to suffer through that same thing. And that's going to turn away a lot of developers. I'll also pause there and say, just the insights that Shari and Bob have shared already have been so meaningful and helpful. If anyone who's listening to this is thinking about buying or selling a property in the outdoor space, definitely give these two people a call to get their help and advice and services. And I think that's already being demonstrated. Maybe we could move from there and maybe just say, maybe you could give us an overview on what you think's happened with valuations, kind of starting with pre-COVID, and like moving through each of the 4 years and like where you see it today. Because I know it's been a little bit of a roller coaster, particularly in our outdoor asset class. But yeah, I mean, Shari, maybe starting with you, and then we could move to Bob. Just like what's kind of happened with demand and valuation in this space.
Pre-COVID's a little bit of a tough question because we were just starting in this space right before COVID, like really in a meaningful way. But I can, from the RV resort perspective, which have been going for a very long time, the trends were super positive, supporting the industry and the need for modern, high quality designed resorts. And the kind of the driver of the need to disconnect and get outside was already happening. Interest rates were decent, decently affordable prior to COVID. So, I felt that the market was strong and the outlook was strong. The difference with glamping, I think, was we really only had hotels and RV resorts to look to figure out value drivers, and the market just wasn't proven. It was about trying to find a way to analyze these in a way that makes sense to what other people know. So that part is probably the best part I could say about pre-COVID. COVID, absolutely, between interest rates and people's need to get the hell out of their house, just absolutely surged the interest and demand for glamping and brought its attention in. And cap rates, I think we don't have a lot of transactions during that time, but I would say theoretically, since I'm the appraiser, that they would have been a couple hundred basis points lower potentially. But since the recovery of COVID and the increase in interest rates, have brought valuations down a little bit compared to where they might have been then. So I think that's the best I could say.
That was a very graceful answer to a very tricky question. So thank you. And how about you, Bob? Thoughts?
Well, I do agree with Shari that, there's not that many data points for glamping, particularly pre-COVID. So I'm going to base most of what I'm saying here on the RV world and just consider that cap rates in glamping are probably 150, maybe 200 basis points higher because, as we spoke about before, the FF&E, the more labor aspect, the need to freshen them up, etc. So cap rates definitely came in, or lower, prices went up in 2020, 2021, and the first part of 2022. As outdoor hospitality, glamping, RVing gained so much popularity, we had these really positive occupancy and income numbers. We had all these wonderful numbers about the number of people that were buying RVs and campers, etc. And at the same time, debt was as affordable as it's been in the last 50 years, probably. We had a 10-year treasury at 1.5%, and now it's at 4.5%. So we had strongly rising income statements, strongly improving occupancy rates, and lower cap rates, and valuations went up quite a lot. Most of the income statements I see now have lower income, top line revenue and net income in 23 from 22 and in 24 from 23. We've had 2 years of downward occupancy and downward income. The net income has also been affected by quickly increasing insurance rates and tax rates and labor costs. And so there's kind of a bit of a double whammy. Not everybody of lower occupancy and higher operating costs. A lot of people don't like to hear me talk about this, but this is the reality of the market. It's turning around. We're seeing much more buyer interest now. But if the average cap rate for an RV park in 2018, 2019 was 9, maybe it went to 6.5 in 2020, 2021 when debt was extremely low and there was a whole bunch of enthusiasm. And now it's come back out 200 points to where it's maybe 8.5. And I believe if there was a liquid enough market in glamping retreats, we would see a similar chart of where they've been. And that's reality. Still a great space to be in. I think we're going to see a good year this year. I have a lot of people I'm speaking with A lot of owners I speak with that are telling me their advanced reservations for the coming year are strong, that they're having a good winter if they're down in Florida or Arizona or one of the southern markets. So I see a lot of upside, a lot of positive feelings, but that's where we're at right now.
Mm-hmm. Yeah. Thank you both of you for, again, answering a super tricky question. And to reiterate that, in 2021 and the beginning of 2022, we saw, record demand, peak rates, peak occupancy. There was no hotels open. So what that does is when we're doing appraisals and we're looking at comps and we're looking at competitors in their market and how they're performing today, their rates and their occupancy are going to be the best indicators that we have to come up with valuation. And so when those are at their peak, it's going to inflate valuations. And then what happened shortly after that was the construction costs started to come up, inflation started to come up, and then there was a little bit of an economic slowdown mixed with the increase in inflation, which hurt consumer spending. And then the world opened up too. So all of those things hit lower occupancy. And then maybe you could argue that cost of employment, things like that, raised a little bit. So kind of that's why there's this correction happening in 2023 and 2024 that we're feeling. And then we think, if I heard you correctly, we're starting to normalize in 2025.
We're seeing much more buyer interest.
Yeah.
In the marketplace, and we're seeing more interest again. And like I say, we're starting to see how we say green shoots of improvement in the operating environment through occupancy.
Yeah.
I think one point to add too, the data that we track, we've continued to see increases in rates in glamping, but just kind of due to more options being available in the market and a lot of development happening, we've seen longer stabilization periods than we would have looked at several years ago. So that's affecting, the good and the bad as well.
So I want to ask you guys a question. If you were either consulting a buyer, or if you just were in the shoes of someone who's looking to get into glamping, they're looking to buy land to develop as a glamping company, and this person wanted to sell the property or the business in 3 to 5 years, what would maybe be the top 3 or 4 things that you'd be cautioning them or telling them to make sure they're looking for when they're looking at a piece of land to develop into a glamping operation that they want to sell at a high price?
I'm making my notes, Bob, but I've started with year-round demand and strong demand factors for that year-round demand, and probably high barriers to entry. Some of this might be repetitive. I like things on water.
Mm-hmm.
If you could be on a lake next to a ski hill, that would be really ideal. But gotta think about that a little bit.
I think I may say them in a little different way, but I'm very much in agreement, Shari. Unique location is important. Being on water is always great, being in the mountains, but having a unique concept and location, and again, being close enough to enough demand drivers, enough population, it is really quite big. And the concept, the concept, you need to understand what your concept's going to be going in.
Yeah, and speaking to the unique part, a couple things there, and it's not easy to find, but that we have one client in Pennsylvania where they bought an old teddy bear building factory, and that is and it looks like a big red barn, and it's on this rolling land, and that'll always be the story of that property, and I think that's gonna help them with the value. Just a story always makes things far more compelling. The Bahamas project is an old beach club where the Rat Pack used to hang out, and that's always going to be just the coolest story that people will go there, even when it's not fixed up, just because that's its history. So I think the story adds to the uniqueness for sure.
Yeah, it's not, you probably don't hear a lot of, brokers or appraisers talking about that, but I think it's a really good point. Yeah, how good of a story can you tell? And I think we've, from all the discussions we've had on this podcast about marketing and social media and your website and customer engagement and, marketing stickiness, like what is the story that you're telling about the land, the town that it's in, or the entrepreneur who's building it, or the history, is super important. And then you touched on one other thing, Shari, which I think is super important, and that is seasonality. Um, it's just, having done so many of these, and I'm sure Bob would agree, like it's so hard to paint a pretty financial picture of a business when you're only open for 4 or 5 months of the year. It's just your expenses, whether that's a manager, whether it's your taxes, even your utilities are still going to run year round at some level. You're going to have to deal with seasonal staff challenges. And if you're using a canvas-based unit and furniture that's going to have to be stored or taken down, or even just winterizing a property is, flushing all the pipes, putting things away, like you're going to start each season in a cash flow hole because you have to de-winterize the property and get it up and running again, and that's going to have a lot of wear and tear on your units and your furniture. And then you only have 4 months to make all your income. So it's, do your financial projections, because yeah, it's really tough to see a business, particularly a canvas-based unit, have a pretty financial picture if it's only going to be operating 4 or 5 months of the year. You want to comment on that, Bob?
On the whole, it makes it harder. We've seen some RV parks that do extremely well in a short season, but you have to really kill it for 90 days. You have to do really well. Some of them can handle it. They've done it for a number of years. It is definitely harder with a glamping retreat where you have more infrastructure, particularly if you have to tear them down and put them up, each season. It does add to your cost, but it does add an additional challenge. And then if you get a disruption in the middle of that short season, your whole year could be blown. So there's definitely a higher risk factor. Quite frankly, in the RV park world, I think properties with a shorter season trade at a bit higher cap rate
Hmm.
for that factor.
Oh yeah, yeah, yeah.
But on the whole, you're correct. We have seen some that have really high occupancy and in the Dakotas or wherever else, and are able to do really well because of that. Their expense structure is much lower. But on the whole, it makes more of a challenge if you're up north. A longer season, the 7, 8, 9 month season is always much better.
Connor, I remembered one really. This doesn't always come into play, but when looking for land and wanting to maximize value or at least reduce risk, campgrounds or glamping properties can be an interim use sometimes too. If you're in the path of development, and as long as you don't over improve it, knowing that land might be the perfect single family estate home development someday, or something else that you know banks like that, investors like that, you've got a backup plan. And if you can find that perfect scenario where it feels private and it's still great for glamping, but someday it might be worth more as something else, someone's a lot more likely to give you money for that, knowing that that's the worst case scenario, that underlying land's going to continue to kind of grow in value and maybe be worth even more.
Let's dive into that, because it's a really good point. And if you're an entrepreneur and you're doing due diligence on land, or you're buying land, really keeping in mind, what improvements can I make to this property that's going to be valuable to any future buyer, regardless of what that use is going to be. If you're putting roads and utilities into property, that's almost always going to have inherent value, unless it's, unless it's just not a desirable piece of land for any other uses. But, those typically will increase the value of a property inherently. So most of the time, and you guys are the experts on this, so I'll get your feedback, but most of the time that's just going to increase the property value. So it's a relatively low risk investment, depending on, there's a lot of nuances to that statement. But maybe you guys could just share examples of, properties that had an alternative use that hedged the downside of a property, or, a value was captured later for an alternative use.
Oh, I don't have a specific example. I'll let maybe Bob does, but what it does make me think about is unique stay properties and glamping properties that are more stick built, and that they could be sold off in the future as vacation homes, depending on how you set it up legally, or even if you don't necessarily have to subdivide it at that time, or it's hard enough sometimes to get your approvals. But to me, that's one example of thinking about the back end risk, and you know that's the best example I could think of. I think it might be hard to design roads and all that with a completely different use in mind. But there could still be some infrastructure like the water main from the road that could apply for future use and that kind of thing, maybe with a little different design.
Yeah, I mean, a covered land play with the residual value of the land being a backstop is always nice. I don't think it's a primary driver for most investors, but it's a nice backstop, exactly as you said, Connor. And yeah, if you had a larger property in a rural area and you could work for whatever 5 years, however long it takes to get it subdivided into a large lot size housing development while you're running a glamping retreat, that would be a great backstop and a great business plan. We've marketed a pretty sizable property, 170 plus, or again, it's an RV park though, that was right off of an interstate near in a city. And there definitely is a covered land play backstop. It's a growing part of the country. It's a growing city. The zoning allows other uses that might be, to use a appraiser term, a higher and better use. So that's one of the attributes of that property which causes the value to be firm, to be strong. But for glamping, it would definitely be something along the lines of, buying a few hundred acres, using it for a glamping retreat, and eventually something along the lines of subdividing it into ranch lots or building a grand resort, perhaps.
So the takeaway for the listeners there is, if you're buying a piece of property and you're fundraising, or you're putting money into it, just think like, hey, are these improvements to this property going to apply to a backup use, so that if for some reason we can't raise the money or we can't do the full build, is there a backup plan for it to be subdivided and used as houses or some other use where, if you put in those utilities, you might not necessarily make money on that, but you won't hopefully lose money on it either. So it's lower risk of spending that. What is your guys' opinions? Kind of talking about the seasonality conversation made me think of this, and particularly like, if you're trying to do glamping and you're in a seasonal location, one way to mitigate that is to use hardwall units. And I love Canvas, and I think it creates a really special experience. It also has a lot of challenges, and I'd be curious from a valuation perspective, how do you guys look at, or how do buyers look at a property that is utilizing Canvas versus hardwall units on axles or stick-built units?
I have one technical answer to that, and I'd love to hear Bob's thoughts from a risk perspective. But the main thing that we have to focus on is making sure you understand how much cash reserves you need to more frequently replace your units that are either worn out or damaged. I don't know if there's enough data in the market to prove that a glamping tent resort would sell at a different cap rate than a hard structure, but I do think there's probably some difference there. So what do you think, Bob?
I don't think there's empirical evidence yet because of how few have traded and all the other factors that dial into a valuation. But clearly, there's the stick built would be the highest value, and yurts and canvas type accommodation is the lowest, as far as it would have a higher cap rate on that income because of the replacement reserves and the cost to continually replace them. But it does give you a bit more flexibility. We see very few properties that have only one type of accommodation. Obviously under canvas is all under canvas, but many of them will have some globes, they'll have some tiny homes, they'll have some stick-built homes, they'll have a mix of all three. And I think that's quite healthy. You have clients that can guests that can have different experiences. Maybe they come this year and they stay in a glamping tent, but they come back next year, or maybe they come back in the winter when it's colder and they stay in one of the stick-built units, etc. We just don't see that many that are all of one type of accommodation.
The other factor I just remembered is has to do with operating expenses, particularly taxes. The unit type can affect your taxes depending on where you're located. If you are a park model, or you are a park model cabin which is what's movable, or you are a glamping tent that can be taken down and put up, it'll be considered personal property and not real estate. And some states tax personal property and some don't. And that could make a pretty big difference in your operating expenses. And it's something to make sure that you get in your numbers correctly.
Yeah. So to add to that, in some areas, you might have, if you have stick-built units, those could be taxed very high, at a high real estate tax rate. But if you have units on axles, or you have canvas-based units that can be, quote unquote, taken down, the county assessor might look at those as non-real estate, and they won't be taxed and included by the assessor. You might have to pay DMV taxes, but those are typically a lot less. So there's some big tax savings with that strategy. Going back to the question I asked earlier, but a slightly different tweak. Before I asked if there was someone looking for a property, what were the factors you'd be looking for? But I want to ask that again. But if someone is currently operating a business, and let's say they're in year 2 or 3, they're starting to stabilize, and they're hoping to be stabilized soon, and they're looking to sell by year 4 or 5 and get a maximum valuation and return on their business. What are the main things that buyers are going to look for, or that you're going to look for in your appraisal valuation, that are going to impact that sales price?
I'll take a stab first. I think first of all, start working with a broker and or an appraiser more than just a few months ahead, perhaps a year ahead, to help you strategize on how to make that exit. Clean up your books and records as much as you can. Investors are always going to doubt or err on the side of caution when there's unclear books and records, and so you're going to get less of a full price. Do some of the little high return CapEx projects that you've been considering but just haven't gotten around to doing. I'm not saying go and spend another $250,000 on this, that, or the other, but these little things you've been meaning to do that is a nice little add-on. I would do all of those and try to get a full season with those things done. Position the property for more growth. As we talked about, entitled land is worth much more than unentitled land. Get that entitlement for those extra units. Those are some of the things I would suggest. Make sure your management team is strong and in place. Make sure that you're replaceable. On-site owner, delegate as much as you can so that there's a team in place to do things. An owner that's not in working the front desk or in working the property 5-6 days a week that property is more sellable if he's managing the managers instead of managing the property.
Yeah, and I'd like to reiterate on that. So a buyer is going to want to see that they can buy your property and it can run without you, and that the identity of that property maybe isn't so tied to you being there and being the face of it. And oftentimes what makes a glamping property so successful is the face of the entrepreneur. So that can be a tricky thing to juggle. But it is something to keep in mind where, you as the owner, and you want to make yourself as the manager, not a factor, because that's, buyers will look into that.
Yeah, totally agree with the clean records. Because if you can't figure out why something is the way it is, and it's confusing, then you're just going to go off of your market knowledge, and it could end up, and we do err on the side of caution if we're unsure. So it should be very clear what your average occupancy has been by month over the last few years and your rates by unit type. That's very difficult to get on existing properties, surprisingly. And also have an open book to potential buyers. Kind of that level of cooperation, I think, is always better than really having people guess. So I've seen that a lot where that's kind of resulted maybe in not as good of an interpretation of the potential of the property. Booking out too far in advance at fixed rates is not a good thing. I think it's good to show that you've got advanced bookings, but if you're a property that might maybe you're running this is actually property I looked at buying where it seemed like some of the rates were under market, but they're booking it out over 2 years in advance. So there was no room for a new owner to come in and raise the rates, to support what maybe the valuation needed to be. And then I guess with any kind of new endeavors, like let's say you just started renting golf carts or something, make sure that you can prove the momentum of that income stream, rather than just saying, we did it and not having the detail on it. Trying to think what else. I agree with what Bob said as well. It's kind of interesting too, because, when you look for ways to add value, if you're a buyer, you're going to look at what the marketing program has been and, what the website's like and those kind of things. So, if you make those big adjustments right before you sell, that's going to be a little bit more difficult. It's sort of a nuanced answer, but you can, an educated buyer would go in and say, oh, I know I can market this a little bit better. I know that I can make better photos and make the website better. So if you're selling, share those ideas with your broker and share those ideas with potential buyers so that they see where the growth can be. I guess that's the point of that.
I agree.
Yeah, and Bob can probably reaffirm this, but yeah, the way buyers are going to look at a property is they're going to say, hey, we're going to come in. This is how the company or the property is performing right now. Is there low hanging fruit, operational changes, marketing changes, automation technology? Is there easy things that we can do as a buyer to improve that and get value out? And I don't know necessarily what the answer is well, I guess as the seller, you could have a clear plan and you could share that with them. But it's just something to keep in mind of a buyer's mindset. So is there any value, or how would is there any value, and how would you value like a strong brand? And essentially what that is probably three things. And that might be good customer reviews on like a Google reviews, a large social media following like on Instagram, and a large customer database of emails that you can contact and target with email campaigns. Is there a value to that? How is that quantified?
I think it impacts the risk rates or cap rates because a strong brand lowers the risk. I have no idea how to how to totally scientifically quantify it. I'll be very honest with that.
Yeah,
How about
those things definitely help, but I don't know how to quantify how much they help. They help, but in some regards also they can, if you do have some of those problems, but you have a good location and a nice property, some of those can be a buyer opportunity. If there's bad reviews and you guys haven't been marketing it well, it can be an opportunity for a buyer, but it's not going to help your trailing income, et cetera. It's hard to understand how that's quantified. Having good pictures, a good website, a nice client list, and good reviews. It's very hard to quantify that.
So before we wrap things up, there's one more piece, and this is for the ambitious listeners who want to open a multi-site chain and have 3, 5, 10 locations. And Shari, I know we've fielded a lot of calls about this, and if you look at the glamping market, you can see, and that is basically any brands that have over 5 locations, for the most part, have gotten strategic investment, brand partnerships, or acquired by the major hotel brands in the last 3 years. And that is Under Canvas, Auto Camp, and Getaway. They all successfully got between 5, 10, or even more locations. And, they got acquired or strategic partnerships. And those are the 3 biggest players in our space. And I maybe I'll just start by answering it for myself from my own experience, and that is there is a huge appetite from the hotel world, from institutional buyers, basically anyone who's in hospitality and wants to diversify and be on the leading edge of the hospitality trend and get into this space. But most of those big fish want to see a portfolio buy, and they want to see something with more than 5 locations. So I guess, do you guys have any insights you can add to that, or if you have a different opinion about folks who are wanting to shoot for more than 5 locations and sell a portfolio to a larger fish buyer?
Well, I think in glamping, that branding and marketing and concept is uber important. The image, the concept, the brand is really important. You've shown why the 3 groups that have been acquired have a very distinct focus locationally, client base they want to attract, guest base they want to attract, concept, etc. They're very specific on that, and they've executed that. For right or wrong, whether it's going to be enduring or not, we don't know, but they've done that. And I think those hotel chains and hospitality chains really do want that. So I think it's very important. Can't stress that enough, quite frankly.
That's along the lines of what I was thinking. That it has to be a very unique proposition that's super clearly defined and different from the ones that are out there. So where could that be different, or how? There's not really a family focused glamping brand out there yet. I know there's a lot of people looking at it and doing, starting to do it in one location. There's not necessarily a super ultra luxury or high end brand, which is obviously a lot trickier for multiple locations, but it could be fewer units, and your own private pools with your units. And just so I think there's opportunities in different segments. Obviously a lot of hurdles and challenges to do it, but there's definitely room for more.
And my understanding is there's just not a lot of buyers looking for small properties with less than 20 units, that might have revenues that are less than $500,000. There's not a ton of people there's not a lot of professional and institutional and sophisticated buyers that are going to want to buy a ton of small properties with small unit counts and small revenue. A lot of the bigger fish are looking for, they can come in and buy a portfolio of stabilized assets that have room for growth. And I think that opens up to have lower cap rates and attract, bigger buyers with deeper pockets. I guess, would you guys agree with that?
Yeah, and there's definitely a differentiation between cap rates on lower income properties and higher income. By income, I mean the size and the top line revenue and the net revenue. We actually have found in some of the consolidators in the RV park world that some of them made mistakes and bought properties that were too small. Even today their top line revenue is below 600,000 or something, and they're very hard to manage. They're very hard to bring into part of a larger portfolio, et cetera. And you're seeing that in glamping as well. And that's the hard thing, is a lot of these glamping retreats have a small number of units and a lower top line revenue. Those will most likely get passed over by the big groups for sure. And so you need to find a local buyer or a regional buyer that maybe has a hotel nearby or some other hospitality nearby and is looking at that, you're not going to find the consolidators and the big money looking at those unless there's strong occupancy, strong demand, and a path to whatever, $1.5 million of annual gross revenue within the next 3 years or something. There's got to be a path if they're not there.
Yeah, and I'll add to that and kind of solidify that by saying most sophisticated buyers are going to be wanting to look for properties that have over 50 units or over $1 million in revenue. Is a pretty common threshold. So if you're able to get over that mark, you're going to open up your property to a lot more buyers and be able to get a better price. Would you agree with that?
Yes, Shari, I agree.
All right. Well, why don't you guys just share with, this has been extremely informational on a really a nuanced and difficult topic. So I really appreciate both of you bringing your depth of experience to this audience. It's extremely valuable. So if someone wants to get in touch with you about your services, what's the best way for them to do that?
Our website, which you probably just heard an ad about, is www.sageoutdooradvisory.com. And you can also email me with my last name, Heilala. That's Heilala at sageoutdooradvisory.com.
And our website is naiohb.com, www.naiohb.com. And you can also email me at Bob Kaplan, Kaplan, Bob Kaplan at naiohb.com.
Nice. Any other asks of the audience before we sign off?
Hey, just sorry, appraisal and value is kind of a dry topic. I didn't get to crack as many jokes as I would. But, not an ask, but I hope this was valuable and
All right.
Good luck. Yeah.
All right. Thank you, Connor.
Thanks, guys. Hello, friends. This episode is made possible by the support of Live Oak Bank, the industry leaders for outdoor hospitality financing and the largest SBA lender in the country. If you want to learn more about their services and if it's right for your project, you can go to their website, liveoak.bank.